Welcome to Blaxe Academy. This is the Pattern Playbook, Candlestick Edition. Today we will be talking about one of the simplest and easiest to identify candlestick patterns in the entire library, the hammer pattern. The hammer is indeed probably the simplest pattern of the entire library. It's just one bar. You can see it over to the left. It's either green or it's red, and it kind of looks like a hammer if you play Minecraft. Anyway, the hammer is a bullish or a buy signal. The way that candlestick patterns typically go is that buy signals happen at the end of either short-term pullbacks in the market, which we will call retracements in technical terms, or at the bottom reversals of a trend change. As the trend is going lower and starts to move back up, you typically will find reversal patterns like the hammer. The hammer in and of itself has a lot of different names. You may have heard it as a pin bar, or, some people confuse it with the hanging man, which looks exactly like the hammer, except for it's at the top of a chart. And alternately, there's another form of this where it's this shape that's just turned upside down, and that's called an inverted hammer. But aside from that, the main thing you need to know about the hammer is that to use it best, you find it at the bottom of trends or near the end of a retracement, which, like I said, is a pullback. The other useful spot to find them also is within support zones. You can also find them in consolidation in the market, which is periods where the market has tight price range and the price doesn't move out. Consolidations typically happen before the price breaks out. In this case, a consolidation would happen in the price as the price would break out to move higher. You can also find hammers in there. Again, it's a very versatile pattern, but what we're going to do now is show where we're going to look at some examples of where hammers can be found in the charts. And I'm going to give you some good ones, some ones to avoid, and some other supporting factors. Because as you see in the extra note, it's really good to use other patterns to confirm the reversal for the hammer pattern. Because the hammer in and of itself, because of its simplicity, is not the strongest reversal signal in and of itself. Okay, here we have a chart of Nvidia, and I chose Nvidia because it's a pretty well traded stock in the US stock markets, and being a part of the NASDAQ, being a tech stock, you're going to get a lot of volatility, which is good, and you're going to get some reversal patterns on long-term charts, as we see here, on the daily chart, and also on smaller short-term charts, which is good for day traders. A lot of the tools that we use at Blaxe Academy can be used for day trading, but they can also be used for swing trading and another number of other strategies as well. For most of our strategies, simple tools for pattern recognition and identification like candlesticks really come in handy, and they form the building blocks of what you should first look for when you're deciding, hey, what do I do in this market? Do I go long or short? So with that in mind, we're going to just take a look at this chart. And you can see here it's not really well defined. I'm going to zoom in. In this chart, what we're going to be looking for is not at the tops, not at the peaks. As the price moves lower, and this is a big move down here, late 2018, we should start looking for hammer patterns near the bottoms. And of course, at the time, you may say, well, you won't exactly know where the bottom is, but the candlestick patterns themselves, along with some of the other technical tools that we use to look at charts and analyze price action, can give you an idea of when the bottom is actually going to happen. Yes, we're talking about market timing. But for now, I'm just going to show you that at long as big moves like this one and even short-term moves, you can often find candlestick patterns. I don't necessarily have a specific spot in mind per se, but I'm just going to make a bet that at the bottom of some of these trends, we're going to find hammers. And as you look closely here, I'm going to identify just a few of the hammer patterns. This fits our description from the previous slide. Has a little handle here, this bottom shadow, and believe it or not, it has a red body. If you saw this pattern, perhaps you saw it up here, we have to remind you that placement for candlestick patterns is so important. One of the main things that makes this lower hammer superior to the one up here as a reversal signal is the fact that it is positioned lower in the market relative to what you see. And sure, I don't see all the market, but I see enough to understand that there was a trend that moved up from over here all the way to this peak. And there's actually a hammer at the top. This is not the type that we would use. This isn't technically a hammer. This is another type of pattern, but it's in the wrong position to denote a long reversal or a reversal for buying. But again, these are two examples of where you don't want to see a hammer. I don't want you to ever say, well, I bought here in the market because I saw a hammer pattern. No, you don't want to buy here buying the premium price. This is a price that's going up. But instead, for reversal patterns, what you want is the price to move back lower. And in the second pattern, you may say, well, hey, here are two hammers here, especially this one big red one. Why don't I buy here? Well, the price has just started to move lower, and there's not necessarily a support zone for that. If you look backwards, the first, just looking at if you knew nothing about technical analysis other than support resistance, you would see that the first support zone doesn't come before here. So therefore, any hammer pattern or thing or whatever it is, like this is another type of pattern that is very useful that we'll have videos on as well. But none of these patterns give you a good idea that the market is going to change direction anytime soon. And in the space where there is some support, and this is just really minor support here, it's a big void. The market actually gapped lower. Now, this hammer in and of itself is a reversal pattern. You could take this trade and say, hey, I'm going to buy Nvidia around here, and having the benefit of hindsight and looking back in the past, we can see that it would have worked. However, buying just a single pattern like a hammer, to me, doesn't necessarily mean the best outcome for you long term if you just buy every hammer pattern you saw. Instead, if you were simply to use just candlestick patterns in and of itself, I would wait to see if there were more hammer patterns. Like here is a one, it's not the best looking, but what you're starting to see is a number of patterns grouping together. They're forming a support zone of themselves. And once you start seeing the pattern repeating a good bit, like I like this red hammer even better than the first one that we noted, simply because you have an aggregate number of candlestick patterns now that are starting to tell you the same thing. They're starting to say, hey, the market is trying to find some type of balance or go back the other way here. Once you start seeing a group of them, and they're not all over the place, they're kind of tightly grouped. In fact, the first one that we saw kind of encompasses the entire range that the other ones are kept in. So here and here are ideal positions, just looking at the candlestick patterns alone, to say, hey, well, this is a market that I now believe that I can buy. And of course, you can see the price goes up from there. In addition to this, what I like to do, and if you've looked at our Foundations of Trading course, you'll understand that support and resistance can be shown objectively by using Fibonacci retracements. And you don't necessarily have to be very familiar with these things, but we would encourage you to look at the course and look at some of our other material to show you how to correctly draw and analyze Fibonacci zones. They can show you where support is that will coincide with these candlestick patterns to give you an even better advantage. Let me show you. Looking simply at the range of where the market hit the low and reversed, and we can see that. That's easy to see. This low over here is where the market went up. Just use your eyes, and goes up to the other erroneous hammer pattern at the top. We would use this as a basis to draw a simple retracement from this low to this high, and understand that this 61.8 is arguably the most important part of the Fibonacci sequence, and using them in Fibonacci retracements and projections and other tools, 61.8 is a very important number. Right here, you can see the 61.8 line, just like the other lines, denote areas of support. As the market goes up and starts to move back down, you can see that once we hit this 61.8% level, this is a flat line. It's just a price. This price is roughly 150.09 in Nvidia. We start to see hammers form. This is beautiful confirmation. This is how you use two types of tools, both of them fairly basic, but together you get the advancement. You get an advanced tool together that says, hey, I'm using two types of technical analysis to understand better where the market is. So once you see your candlestick pattern hits that Fibonacci level, that gives you a little bit more confidence that this is a level that you can buy with a higher probability chance that the market is going to continue to go up. That's simply how you use candlesticks. And I just found one area. There are several other areas that will follow this same type of logic. As I was stating earlier, what you want to see and want to avoid really is to be too early on your candlestick patterns. Here, this one, I wouldn't necessarily be mad at a trader to say, hey, I decided to see this hammer and I wanted to buy because, well, the market had gone up for a time and it went down for a time, and now I see the hammer and that's what you said. Well, yes and no. The timing portion is what's critical here. In the prior example, the market not only went down a great deal in terms of retracement level, and you can see that if I was to draw a retracement level from here to here, the market exceeded any of them, so it was a really deep retracement. But what's not shown here is the fact that as this hammer forms up, it's a little too early, because if you look at just the price movement from this high, this hammer pattern forms very quickly in terms of how many bars, how long did it actually take? And what do I mean by how long did it actually take? Well, if you measure from the point where we were looking, and notice I'm not showing you a lot of these charts because you don't necessarily need it, but I'm showing you from points of motion to motion, from a relative low spot in the market to a high that we can see. You can see that there was 64 bars, and these are days. This was 92 total days, an entire quarter. It took Nvidia to go from this 240 price up to this high of 290 before reversing. Only 10 bars later do we have our first hammer pattern. Well, the time of a move actually matters, and granted, moves lower in the market are oftentimes faster when the market changes direction, but 10 bars versus 64 bars, this is a very short period of time. You might need to, and you'll learn this as you trade and progress, you might need to wait this one out a little bit longer. As you can see, we go through here, the market starts to find some areas of bouncing, and there's a hammer here, but it's out of position. It's not at a low point. It's just kind of as the market's bouncing higher, it sees a hammer forming up. This is not it either. This one's no bueno. However, as the time starts to move further and further and further, you'll start to see some basing here in the market, and there we see a hammer pattern. What's interesting here is the support zone that I drew in our first example can still be seen here. And lo and behold, even though this candlestick is slightly below it, you can see that this zone is a particular point of emphasis for the market. It just goes to show you that even over time, points of emphasis in the market really matter. But to this effect of what we're talking about here, now that we've gone further and further in time, we've now gone 60 days. And as you start to get over here, we're starting to get hammers that make a little bit more sense. Again, this is not necessarily, I don't necessarily like this one, but I would not be mad at a trader to say, hey, I thought this might be a buying opportunity, because if you look here, the market has made a low, moved up, and has come back to test this low. This would be considered, to some extent, a weak double bottom. And I say weak because it didn't necessarily hold. The candles, hammers can be red or green. I typically prefer green candles because when you have a green candlestick pattern of any sort, no matter what the geometry, no matter what the shape is, when it is green, it means that the closing price of that period of time, here is days, but it could be hours or minutes. During that period of time, the price rose higher than where it opened. That in and of itself is a pretty common sense way of saying, hey, that the market's starting to gain strength. You don't necessarily have that with a red candle, because what happens in a red candle is the pressure of selling is still there and it closed lower than it opened. Now, in a hammer pattern, even a red hammer is going to close higher than the lowest low. But as you can see, if it's supported by other factors such as a support zone at Fibonacci level, you can have a red candle bounce the price higher just like a green one. But in terms of probability, I like to go with green hammers, especially when you're trying to find a market bottom. A lot of market technicians will tell you don't even worry about finding a market bottom. But I will say that I've had lots of success using these convergent tools like the support zones and the candlestick patterns, and even a few indicators that we'll show later in some of our other courses of how to use these candle patterns to find places in the market of inflection, which means where the market will reverse and go higher. And you probably have noticed already, since I've been talking, that there is a perfect looking little green hammer, and it's in between two patterns called dojis, which they in and of themselves are pretty strong, significant reversal patterns too. And it's followed by another, that's not quite a hammer, that's actually almost an inverse hammer, so a hammer that's turned upside down. But these patterns in here are starting to denote reversals. So we have hindsight on our side. We can definitely see that the market would move up from this spot. And it does. So this gives you an idea of how to find the hammer pattern, a very, very simple pattern, in reversals and also some in retracement or when the market pulls back. For another example, I can show you here that there's yet another one in a really nice little pullback as we're coming off that low. The hammer itself is green. It has a short little handle, short little shadow on the bottom, but this is fairly ideal in terms of a reversal. And I will show you again why, because as I draw Fibonacci's, and I can draw them from multiple levels, you will see that there's Fibonacci support where this hammer is going to be. And once again, I will show you my reference points for my Fibonacci lines because they're not always obvious for beginner traders. But I'm going from a low point to a high point, drawing a straight line. And the Fibonacci measures the points of support and resistance here. You can see that the 38.2 and the 33% levels are up here, but this candle sits almost directly in between, like sitting exactly on the 50% line, and it's almost touching the 61.8. But in this tight space, because the price is a pretty tight range in here, this is good enough. And you get confirmation of it after, because you get this large green candle. And remember what I said earlier in the first slide, that oftentimes, even with candlestick patterns, like simple ones like hammers, you may need to wait for confirmation. This big green candle kicking off after it is confirmation enough, given the fact that it moved from this low to this high, back to the 50%, which is the halfway mark, formed your nice little green candle, and then kicked off. The price is going to go higher. These are the types of tools that you can use in combination with these very simple candles to trade just about any market. And if you're not a stock trader, that's fine. Maybe you trade futures. The S&P 500 or ES, the E-mini, whatever you want to call it, you're going to see some of the same candlestick patterns, which is what makes them useful. They're versatile. You can use them in any way, any market where the data can be shown in open, high, low, close format. And that's pretty much the standard format. This, instead of going on a daily chart, I'm on an hourly chart. Maybe I'm a swing trader in E-minis. And one of the things I like to do in terms of candlestick pattern, like the hammer, is to see and test out at market lows. Well, were there any reversals? These look like hammers, and there's kind of sort of one here, but that's not really a reversal to me. What I do see is, and this is in a sort of problematic way, looking at how we were looking at the prior market, which was Nvidia stock. Here's a bunch of hammers. And they're starting to form in that same tight space that I was talking about, but the price kept going lower. Now, granted, no candlestick pattern is going to be perfect. No pattern is going to hit every time. But as you're starting to see and use your candlestick pattern, it is good to note. And note this in your trading journal, where the pattern works and where the pattern does not. Because as I see here, looking at reversals, these deep retracement reversals here, I don't necessarily get the warm fuzzies about a hammer working in the S&P future. However, I do see a spot over here that seems to work much better. So when I'm trading Nvidia, maybe I can trade off reversals off the lows in addition to retracements. But as I'm looking at the S&P 500 here, and I haven't looked very much, but I see a place where the hammers do not seem to work and they go lower. You know, maybe there's not enough support here. If I draw my Fibonacci retracements, maybe they're not there. Let's try it out. We're going to go from this low up to this high. But you can see on this second set, there was Fibonacci support there. The market didn't care. That happens sometimes. So as I'm making my mental notes, these candlesticks that form, these hammers in specifically that form here, that may not be my best bet for reversal when I'm looking at the market's change direction significantly and it's starting to go down. However, as this next bounce happens, we can do a Fibonacci again, and I bet we're going to find support here. And we do. Just for reference, once again, I'm going to draw where I started my Fibonacci from a low to this high point. And as we retraced, we got a really clean hammer here. Now, granted, for those of you that know candlestick patterns, you will know that this hammer is included in a much larger, much better reversal called a morning star. But if you didn't know that, it doesn't matter, because if you did know that hammers form in pullbacks and support zones, and you can find those that are confluent with Fibonacci levels like we're showing here, this is sitting right on top of the 38.2% level. That's all you needed to know. You didn't even have to know that this was a Morningstar pattern. What you know here is that in the S&P 500 future, at least over what we've seen, it seems that hammer patterns work better in minor pullbacks, because what happens after this is a really beautiful move up. That's really beautiful. You can make a lot of money even on a single contract trading the S&P future if you're able to pinpoint that level. And what's better is you're able to control your risk, because if you were to look at this in terms of how much risk you had to take in points versus how much you were looking to get, if you entered as this candlestick pattern closed, and that's another thing about candlestick patterns, always enter the position after they close. Do not jump a candlestick pattern. Wait for the candlestick pattern to close. You can put your stop loss below this 50% level. We're risking 13 points. But the upside here, just looking at here's 35, 50 points. Your risk to reward is 3.89, almost 4 to 1. That's a great looking trade from a risk management standpoint. If this isn't familiar to you, make sure you tune in to our Foundations of Trading course, our risk management course, or a number of our other technical analysis courses that put this all together. But I wanted to give you a good example of how to use the basic pattern, a hammer, in technical analysis of multiple markets. And honestly, I'm not even done here. I can look at another market. Let's look at one more. This is Bitcoin, everybody's favorite market right now. We can find these same hammer patterns in the same situations. Earlier, as I'm looking at the chart, we were talking about what consolidation is. Well, I'll show you a good example because one just presented itself. This, as the price moves up, you notice the range starts to tighten down. What happens there is a degree of uncertainty hits the market and traders don't know whether to go long or short. They don't know whether to buy or sell, etc., etc. You will find hammers hanging out in the tightest parts of that consolidation period. This is a great spot to strike. And so we're going to zoom in here. This is Bitcoin in dollar terms. And lo and behold, as you can see, there's a number of hammers. They're all grouped together, tons and tons of little hammers just about everywhere. They pretty much form up the basis. But as you look at the patterns, you can kind of see what the range, you can make a range of them and see where's an ideal spot to enter the market long. This is a little short for retracement. So, some of the Fibonacci technicians, you may miss this level because it really isn't a standard Fibonacci level. Let's see. It may get down to a 23.6. Let's put this in. But this is a very short retracement, which is characteristic. Sure. Yeah. It got down to 23.6, but the price actually hovers above that. So if you're using just Fibonacci on its own, which is why candlesticks are useful, you may miss this level. You may miss this consolidation period. But you can see that it technically touched it and is supporting right above the level. Use any of those candlesticks to trade that breakout. It's not necessarily always going to be a big breakout, but the breakout itself is highly probable. Not guaranteed, but highly probable. And once again, depending on which one of these candlestick patterns you pick, it really doesn't matter. You can put your stop well below this 23% level, which would form as support. There's actually another level down here if you're a little bit more conservative. There's a 27.2% level. But even if you go for the more conservative thing, the breakout itself, you're looking at another almost 5 to 1 trade. Great odds. If you get $5 for every $1 that you risk, and you can be anyways accurate, you're going to make money. So we've now covered 3 markets. We covered crypto, Bitcoin, we covered the S&P future, and we covered Nvidia, which is a stock traded on the NASDAQ, showing you how to use a simple hammer. Here's another one. as a tool to show you where the market will reverse. We're going to have dozens of other candlestick patterns, some to play along with this as well. We hope that you join us, and we hope that you always have enough to move forward. Thank you for listening, and happy trading.